Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Market PEDIA, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Market PEDIA is here to rock your world. Inflation is a growing concern for many investors, especially lately. For about 40 years, we haven't had to worry about inflation. It has been kept around 2%, which is considered ideal. However, some well-known investors like Ray Dalio, Charlie Munger, and Michael Burry are warning that inflation could become a problem. Munger warned that if too much money is printed, it could lead to a situation like Venezuela, a country that suffered greatly from inflation. Burry believes that studying past events like the American inflation of the 1970s can provide valuable insights for today. Dalio mentioned that as the economy recovers, inflation pressures are also rising. These investors, along with others worldwide, are raising the alarm about inflation. There are various statistics indicating that inflation could become a problem in the not-too-distant future. However, the most important topic we'll discuss is yet to come: how you can actually profit from inflation. Many people are unaware of the potential consequences of the extensive money printing that has occurred in recent times. In response to the pandemic, governments provided financial assistance to individuals and struggling businesses by injecting trillions of dollars into the economy. This money was created by the Federal Reserve essentially out of thin air, seemingly solving our problems. However, the reality is different. Printing money may seem like a quick fix, but it comes with significant consequences, especially inflation. When money is freely distributed, people have more to spend, leading to increased demand for goods and services. Charlie Munger warns that if this practice continues unchecked, we could end up like Venezuela, a country devastated by hyperinflation. Printing money is just one factor contributing to the warning signals of inflation. Another significant factor is the aging global population. Looking back at the 1970s, there was a higher proportion of young people compared to retirees. This demographic composition has changed over time with a larger number of elderly individuals. As people age, they tend to spend less, which can lead to a decrease in overall demand and economic growth. Understanding signals. Understanding these warning signals is crucial because the consequences of inflation can be severe. Rising prices erode the purchasing power of money, making it more difficult for people to afford goods and services. Investments and savings can also be negatively impacted, potentially wiping out the wealth of many individuals. Therefore, it's essential to be prepared and take necessary precautions to mitigate the effects of inflation. It's worth noting that these warnings are not limited to a few investors, but they're echoed by well-known individuals worldwide. The concern about inflation is supported by various statistics and economic indicators. By being aware of these signals and their underlying causes, individuals can make informed decisions and take steps to protect their financial well-being in the face of potential inflationary challenges. Demographic shifts. Inflation. In the 1970s, the United States had more than twice as many young people as retirees. However, today the numbers are almost equal in both categories. A similar trend can be observed in the United Kingdom, where the proportion of young people has decreased compared to retirees. This pattern can be seen across many developed economies. Even China, despite its growth, is experiencing a slight decline in its working-age population. The only exception to this trend is Africa, which has a higher proportion of young people, although it's one of the poorest continents. This decline in the working-age population is significant because it results in a decrease in the overall supply of labor. As a result, the production capacity of economies is reduced, and the cost of labor increases. Businesses, in turn, pass on this increased cost to consumers by raising prices for goods and services. This phenomenon is known as inflation. These are just a few factors that contribute to the potential for high inflation in the future. The crucial question is how to benefit from, or at least mitigate losses during times of high inflation. Most people today have not experienced high levels of inflation and may not know how to navigate such periods. In the past, high inflation led to the devaluation of currency, losses in bonds, and declines in certain stocks and other asset classes. Therefore, it's important to understand which asset classes perform well during inflationary periods. One of the best options to consider, and a strategy that I personally endorse, is to invest in asset classes that tend to do well during inflation. These include tangible assets such as real estate, commodities like gold and silver, and stocks of companies that have a history of performing well in inflationary environments. These asset classes have historically demonstrated resilience and even growth during times of high inflation. It's essential to educate ourselves about these investment strategies and asset classes to protect our wealth during inflationary times. By being proactive and informed, we can make investment decisions that align with the potential challenges and opportunities presented by inflation. Remember, understanding the impact of demographic shifts such as the decline in the working age population is just one piece of the puzzle when it comes to preparing for and navigating through inflationary periods. Top 3 inflation-resistant assets. Gold. During periods of inflation, investors tend to lose confidence in holding cash as its value decreases. They seek out assets that can retain their value and have a limited supply. Gold is one such asset that investors turn to in times of inflation. Historical data supports this trend. Looking back at the period of high inflation from 1970 to 1980, inflation rates were significant, ranging from 5% to almost 15%. During this time, the price of gold skyrocketed. It surged from around $250 to over $2,000. This demonstrates why gold is considered a robust asset to own during periods of high inflation. It's essential to buy gold at a reasonable price before its value rises. I personally hold gold as part of my investment portfolio. Another asset that investors are likely to flock to in the event of high inflation is cryptocurrencies Bitcoin. While there may be skepticism surrounding Bitcoin, it offers a unique perspective in the context of inflation. Let me explain why. Inflation devalues your currency, as we have discussed earlier. The continuous printing and dilution of the dollar diminish its effectiveness. However, Bitcoin operates differently. It has a limited supply of 21 million coins, which means it cannot be diluted or devalued like traditional currencies. As a result, when people lose faith in their weakening currency, they often turn to alternative forms of currency, and Bitcoin is one such option. While we lack historical evidence to validate this hypothesis, there's a significant possibility that Bitcoin could gain traction during periods of hyperinflation. So, in addition to real estate and gold, Bitcoin has the potential to perform well in inflationary environments. These assets are worth considering. It's not the only one. There are other assets that tend to perform well during inflationary times. One such asset is buying real estate. Let's explore the math behind investing in real estate during inflationary environments. Cash is considered the worst asset class during inflation because its value decreases over time. On the other hand, debt is the opposite of cash. Inflation actually works in favor of debt as it erodes its value. This is one advantage of investing in real estate. Inflation causes prices, including house prices, to rise. Therefore, the value of your house increases with inflation. Additionally, rental income tends to decrease during inflationary periods. This means that if you own real estate, not only does your debt become less burdensome, but the value of your property and rental payments also go up. Investing in real estate allows you to benefit from multiple avenues of profit. To enter the real estate market, you typically need a significant amount of money, often in the form of a mortgage loan. However, there are alternative options if you don't have sufficient funds. One option is to invest in a real estate investment trust, or REIT, which pools investors' money to invest in real estate properties. REITs offer the advantage of lower entry prices compared to direct real estate investments. During high inflation periods, it's important to concentrate on certain key factors when selecting stocks. It may be helpful to jot them down. There are 3 key factors to consider when investing in stocks during inflationary times. The first factor involves identifying companies that can handle substantial increases in business volume without requiring significant additional capital investment. For instance, Warren Buffett's long-term investment in Coca-Cola is an example of a stock that can perform well during inflation. Companies like Coca-Cola have the ability to raise prices as inflation rises, while generating substantial cash flow. Similarly, stocks like Sanderson Farm, which can easily raise chicken prices in line with inflation, can also maintain high cash flow. A second factor is selecting companies that can easily increase prices along with inflation. These companies have the flexibility to adjust their pricing strategies to keep up with rising costs, thus maintaining their profitability even in inflationary environments. The third factor is the ability of a company to generate cash rather than consume it. This means investing in companies that have strong cash flow and can sustain their operations without depleting their resources. Favoring these types of stocks would be beneficial if high inflation is expected in the future. It's important to note that high inflation can have a negative impact on personal finances, such as hyperinflation can erode one's life savings without the government having to raise tax rates. However, by investing wisely, it's possible to protect and even grow your wealth during inflationary times. By making smart investments in the right stocks, holding real estate assets, and considering a potential investment in Bitcoin, you can position yourself to profit while others may suffer financial losses. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Market PEDIA, where we make stocks sizzle.